Have you ever done the real math on your money? Not the vague math people do in their heads. The real math, if you wake up at 7 in the morning, spend an hour getting to work, work 8 hours, and then spend another hour getting home, you have spent about 10 hours of that day working for money. 10 hours your body worked, your mind worked, your time was traded, your attention was used, but then ask the question most people avoid. What was your money doing during those same 10 hours for many people? The answer is uncomfortable. Their money was sleeping. It sat in a bank account, earning almost nothing, maybe 1%, maybe a little more if they were lucky, maybe less after fees, inflation, and the quiet erosion of purchasing power. The person worked all day. The money did not. That is the problem. And it is one of the most important shifts a person can make in financial life. You must stop being the only worker in the system. Your money must begin working too. This does not mean day trading. It does not mean chasing hot stocks. It does not mean sitting in front of a screen all day trying to guess whether the next candle will go up or down. If your investment strategy requires you to lose sleep, stare at charts, and feel panic every time the market moves, that is not good investing. That is self-inflicted stress. A proper investment system should be much more like setting a washing machine. You choose the cycle, you put the clothes in, you press start, then you go live your life. You do not stand there opening the lid every 2 minutes to see whether the machine still works. That is how a good asset allocation system should feel. It should be calm, it should be repeatable, it should be boring enough that you can follow it for decades. Because the purpose is not to look smart today. The purpose is to make your money work quietly while you are building your career, spending time with your family, improving your health, and living your life. Now, let us begin with a simple question. If you had $10,000 right now, what would you do with it? Would you lock it into a fixed deposit? Would you buy an insurance savings product? Would you leave it in a checking account because it feels safe? Would you hold it in cash because you are afraid of markets? Many people spend years saving $10,000 and then once they finally have it, they let it sit in the bank earning a few dollars of interest. They worked hard to collect the water, then they carried it up the mountain. But they did not notice there was a hole in the bucket. That hole is inflation. And inflation does not care how hard you worked. That is one of the hardest truths about money. The economy does not reward effort by itself. It rewards systems. If your money is sitting in a place that earns less than inflation, your purchasing power is shrinking, even if the balance looks stable. That is the trick. The number on the screen may still say $10,000. But what that $10,000 can buy is falling. A stable balance can hide a declining reality. This is why the first myth must be destroyed. The first myth is that investing is dangerous and saving is safe. It sounds logical, it feels conservative, it feels responsible. But the reality is more complicated. If inflation is about 3.3% and a 1-year fixed deposit or average savings yield gives you about 1.9%, then your money is losing purchasing power at roughly 1.4% a year. You may feel safe because the bank balance does not fall. But in real terms, you are losing over 10 years. $10,000 of purchasing power can fall meaningfully. In the source example, the real purchasing power may drop to around $8,700. That means you did not avoid risk. You chose a different risk. You avoided market volatility, but you accepted guaranteed erosion from inflation. That is the key distinction. Many people confuse volatility with risk. Volatility is the price moving up and down. Risk is the permanent loss of purchasing power, the inability to meet future needs, or the failure of the plan. Cash may have low volatility, but cash can still be risky over long periods if inflation is eating it. That does not mean cash is bad. Cash is essential. Cash gives you stability. Cash gives you optionality. Cash helps you avoid forced selling, but cash is not a long-term wealth engine if all of your money is cash. Your money is not working hard enough. The second myth is that you need a lot of money to start investing. Many people believe investing is only for people with hundreds of thousands of dollars. That belief keeps them stuck. $10,000 is already a powerful starting line. Not because $10,000 is enough to make you free, it is not. But because $10,000 is enough to build a system, that is the point. The first goal is not to be rich instantly. The first goal is to build the machine correctly. Think of it like going to the gym. You would not refuse to exercise because you only have 10-pound dumbbells. The purpose of the first workouts is not to lift the heaviest weight in the building. The purpose is to build form, rhythm, discipline, and a repeatable habit. Investing is the same. $10,000 is enough to learn asset allocation. It is enough to build an emergency reserve. It is enough to establish a core portfolio. It is enough to create opportunity capital. It is enough to feel for the first time that money can produce more money, that psychological shift matters. If $10,000 earns a 6% annual return, that is $600 per year. That is about $50 a month. $50 a month will not make you wealthy, but it will change how you think, because that money was produced while you were sleeping, while you were eating dinner, while you were resting, while you were on vacation, while you were doing nothing. That is what passive income means at the beginning. It is not dramatic. It is proof of concept. It is the first small fruit from the tree you planted. And once you see that, your mind changes. You stop looking at money only as something you earn and spend. You begin seeing money as something that can be deployed. That is a major shift. The third myth is that investing means staring at charts and doing heavy research every day. If you are a professional investor, research is part of the job. But if you are a normal person working a 9-to-5 job, your time is extremely valuable. If you spend 3 hours every night trying to pick individual stocks, you must ask whether that time would be better spent improving your career, your skills, your health, or your relationships. For most people, the goal should not be to beat every professional investor. The goal should be to participate intelligently in the wealth, creating power of markets. That is what passive investing does. It says, I do not need to outsmart the market every day. I need to own a diversified share of the market and let productive assets work over time. This is not weakness, it is humility. And humility is one of the most underrated investment virtues. The market is large, it is competitive, it reflects millions of decisions. Enormous institutions, research teams, algorithms, and capital flows trying to beat it consistently is very hard. Joining it through broad, low-cost funds is much easier. That is why passive investing can be so powerful. It admits reality and builds a system around it. Now, if asset allocation is so simple, why do most people still fail? They fail because they do not have a system. They hear about a stock from a friend, they watch one video, they buy a fund because someone mentioned it, then the market falls, they panic, or the market rises, they chase, or they invest once and stop. This is not investing, it is emotional reaction. It is like wanting a healthy body running 10 miles once, and then not exercising again for 3 months. A single action does not create the result, a system does. That is why the $10,000 allocation matters. It turns a vague idea into a structure. The structure has 3 layers. The first layer is the safety net. The second layer is the growth engine. The third layer is the opportunity bullets. Each layer has a job. If you mix the jobs together, the system becomes weaker. Layer 1 is the safety net. Out of $10,000, the source system keeps 20% in this layer. That is $2,000. This money is not for investing. It is not for chasing market returns. It is not for proving you are brave. It is for safety. It can sit in a high-yield checking account, a savings account, a money market fund, or a short-term fixed deposit, depending on what is available and appropriate. Some people will say this is a waste. They will say, why keep $2,000 in cash when the market can earn more? That sounds logical until life happens. A pipe bursts, a car breaks, a medical bill arrives, you lose your job, a family emergency appears. If you have no cash, you may be forced to sell investments at exactly the wrong time. That is one of the most common ways investors damage themselves. They do not fail because the long-term asset was bad. They fail because they had no liquidity. When an emergency arrived, they sold in panic. The safety net prevents that. It is not there to maximize return. It is there to protect the growth engine. This is an important principle. Liquidity is not dead money if it prevents forced selling. Cash earns less, but it gives psychological security and strategic flexibility. A portfolio with no cash may look efficient on a spreadsheet, but if the human being holding it panics during stress, the spreadsheet is useless. The $2,000 safety net helps you remain calm. When you know you can handle ordinary emergencies, you can let the rest of the money work. That is why this layer comes first. Layer 2 is the growth engine. This is the core of the allocation. In the source system, 60% of the $10,000 goes here. That is $6,000. This money is built for long-term growth. It is not there to be touched next month. It is not there to be traded emotionally. It is the machine. The proposed structure is a combination of stock ETFs and bond ETFs. Within this $6,000 growth engine, 70% goes into broad stock, market ETFs. That is $4,200. The remaining 30% goes into bond ETFs or investment-grade bonds. That is $1,800. The reason for this split is simple. Stocks represent growth over long periods. Broad stock markets have historically produced strong returns, often in the 8 to 10% range before adjusting for different assumptions and periods. But stocks are volatile. They can fall sharply. They can stay down long enough to test you. Bonds provide stability. Their returns are usually lower, often in the 3 to 5% range, depending on the rate environment and bond type. But when stocks fall, high-quality bonds may hold up better or even rise in certain environments. They are not perfect. Bonds can also lose money, especially when interest rates rise. But in a portfolio, they can reduce the stomach, churning swings that make people abandon their plan. This is the logic of a 70/30th stock-bond allocation. It is not designed to produce the absolute highest return in every environment. It is designed to create a balance between growth and stability. If all the money is in stocks, volatility may be too hard for many people to tolerate. If all the money is in cash or bonds, growth may be too slow. A 70/30th portfolio tries to live between those extremes. This is a system designed for real humans, not perfect robots. Now, the specific stock funds can be broad market ETFs like VTI, VU, or VTVTI owns broad U.S. market exposure. VO tracks the SP 500. VT gives global stock exposure. The exact fund is not the most important issue. The important issue is that the fund should be broad, low-cost, liquid, and tied to a diversified market. If you do not know which fund to choose, a total market ETF is often a reasonable starting point. Do not spend months trying to find the perfect asset. There is no perfect asset. There is only a suitable system that you can follow. Perfectionism often becomes procrastination. Action with a sensible plan is usually better than endless comparison. Now, the source system does not invest the $6,000 all at once. It divides it over 6 months. $1,000 per month. This is dollar cost averaging. The purpose is not to guarantee the best possible result. If markets rise steadily, investing all at once would have been better. But dollar cost averaging helps reduce emotional risk. It prevents you from putting all the money in one day right before a market decline. It spreads the entry points. It makes the process feel manageable. It allows you to begin without needing to know whether today is the perfect day. This matters because many people never start because they are terrified of choosing the wrong moment. Dollar cost averaging solves that by replacing the timing decision with a schedule. $1,000 per month for 6 months. Simple, repeatable. Calm. Layer 3 is the opportunity bullets. This is the final 20%, $2,000. This money is flexible. It is not the emergency fund. The emergency fund protects you from life. The opportunity fund allows you to act when markets create rare discounts. The source rule is simple. If the broad market drops more than 15% from its peak, begin deploying this money in batches. This is a very useful idea. Why? Because during market declines, most people feel fear. They do not have money ready. They are already fully invested or emotionally frozen. So when prices are lower, they do not buy. The opportunity bullets give you a different emotional position. Instead of only feeling fear during a decline, you have a prepared plan. The market falls. You deploy a portion. If it falls further, you deploy more. You are not improvising. You are following a system. That psychological advantage is valuable. The source gives the example of the 2022 market decline. Many people were panicking, but if you had opportunity capital and a plan, you could buy into the weakness. When the market rebounded in 2023, the extra capital invested during the decline could produce strong gains. That is how the opportunity layer works. It does not predict the crash, it prepares for one. Now, some people ask whether the $2,000 in opportunity cash is wasted if the market keeps rising. That is the trade-off. No system eliminates trade-offs. If the market rises without a major pullback, the opportunity cash may underperform. But it can still sit in a money market fund, high-yield account, short-term bond ETF, or other conservative vehicle earning some interest. It is not entirely idle. More importantly, it gives you optionality. Optionality has value. A person with cash during a panic has choices. A person with no cash has only emotions. That is the difference. So the full $10,000 structure looks like this. $2,000 in the safety net, $6,000 in the growth engine, $2,000 in opportunity bullets. Within the growth engine, 70% stocks and 30% bonds. The stock portion can go into broad ETFs. The bond portion can go into bond ETFs or investment grade bonds. The growth engine can be deployed over 6 months. The opportunity fund waits for major market declines. The safety net is not touched for investing. That is the system. Now, how do you execute it? Step 1 is to open a brokerage account. This is much easier than it used to be. Most major brokers allow online account opening with identification and a bank account. The process can take minutes. When choosing a broker, look for low fees, a user-friendly interface, reliable execution, and access to low-cost ETFs and funds. Most major brokers now offer zero-commission ETF trading, so there is no reason to overpay for basic access. Step 2 is to set up automatic transfers. This is crucial. Human nature is lazy. Human nature procrastinates. Human nature waits for the perfect time. If you have to manually log in every month and decide whether to invest, you create too many points of failure. Automation removes friction. Once your paycheck arrives, the system moves money into the investment plan. You do not have to negotiate with yourself. You do not have to rely on motivation. After a while, you get used to the money leaving your checking account, just as you get used to paying rent or a mortgage. This is behavioral engineering. Make the right action automatic. If you wait until the end of the month to invest what is left, there may be nothing left if you invest first. You force your lifestyle to fit around the plan. That is how systems beat emotion. Step 3 is to choose ETFs. Again, do not overcomplicate this. If you genuinely do not know what to pick, start with a broad market ETF such as VTI or VO for the stock portion. If you want global exposure, study VT for bonds. Study broad bond ETFs or high-quality short-term or intermediate-term bond funds that fit your risk tolerance. The key is suitability, not perfection. One fund may be slightly better than another in a given period, but the difference is often less important than actually beginning. Many people waste months comparing tiny differences while inflation keeps working, and their money stays idle. Do not let analysis become avoidance. Step 4 is rebalancing. Rebalancing means returning the portfolio to its target allocation. Suppose you begin with 70% stocks and 30% bonds. After a strong year for stocks, the portfolio becomes 80% stocks and 20% bonds. That means your risk level has increased. To rebalance, You sell some stocks or direct new contributions toward bonds to bring the allocation back towards 70 divided by 30. This feels counterintuitive. You are trimming the winner and adding to the lagging asset, but that is the point. Rebalancing forces discipline. It forces you to sell high and buy low in a systematic way. It prevents one asset class from dominating the portfolio after a strong run. The source system rebalances once every 6 months. That is reasonable. It is not too frequent. It does not turn investing into daily trading, but it is frequent enough to keep the system aligned. Rebalancing may take less than 30 minutes. That small amount of time can keep the portfolio operating properly. Step 5 is to keep learning without overreacting. Investing is a lifelong journey. You should keep learning. You should understand market cycles, inflation, interest rates, taxes, fees, and human behavior. But learning does not mean changing the portfolio every week. Many retail investors underperform the market because they trade too much, chase performance, sell during panic, and buy during excitement. The source mentions that retail investors often underperform indexes by 3 to 5% because of emotional decisions and frequent trading. That is believable because behavior is usually the weak point. The best investment strategy is often boring. Buy, hold, rebalance, keep contributing, learn, but do not react to every headline. This is very important. There is a difference between information and action. You can read about the economy without changing your allocation every time. You can understand market risk without selling everything. You can watch volatility without becoming volatility. A good investor has a system that filters information. If every headline changes your plan, you do not have a plan. Now, what returns can someone expect from this kind of setup? Based on historical data, a 70 divided by 30 stock bond portfolio may produce long-term annualized returns around 6 to 8%, depending on the time period, the specific funds, inflation, fees, and interest rate environment. That does not sound exciting, but compounding does not need to sound exciting to work. At a 7% annualized return, $10,000 becomes nearly $20,000 in 10 years. In 20 years, it becomes more than $38,000. In 30 years, it becomes more than $76,000. And that is with no additional contributions. Now add contributions. If you invest the initial $10,000 and then add just $200 per month, after 30 years, the portfolio can grow to more than $300,000 under the assumed return. That is the lazy way. Not lazy because you do nothing. Lazy because the system does most of the work after you set it up. You are not day trading. You are not chasing every market move. You are not picking 20 individual stocks. You are not panicking every time a headline appears. You build the system, you automate it, you rebalance, you keep learning, you let time work. That is simple. But simple is not the same as easy. The hard part is emotional endurance. You will experience downturns. You will see paper losses. You will question the plan. The market will test you. During the COVID crash in March 2020, many accounts fell sharply. Seeing a portfolio drop 30% can feel terrible. It does not matter how many books you read. When real money falls, emotion appears. But if the portfolio includes bonds as a cushion, if the safety net is intact, if the opportunity fund is ready, and if the plan is already written, you do not have to improvise. That is why the system matters. During a crash, your system should tell you what to do. Not your fear, not the news, not someone on social media. Your system, if the growth engine is long-term, you do not sell because of short-term panic. If the opportunity fund is designed for a 15% market decline, you begin deploying in batches. If the portfolio has drifted too far from the target, you rebalance. If the emergency fund is intact, you avoid forced selling. This is how a system overrides emotion. Your biggest enemy in investing is usually not the market. It is your own behavior inside the market. The market will fall. That is normal. The question is whether you will sell at the wrong time. The market will rise. That is normal. The question is whether you will chase recklessly after the rise. The system exists to prevent those mistakes. Now, there is another point that must be included. Investment returns should not be your only source of wealth. Your human capital is your largest asset, especially when you are young. If you are 30 years old and earn $60,000 a year, and you work until age 65, that is more than $2 million of salary before future raises. Your ability to earn is a massive asset. Many people obsess over squeezing 1% extra from their portfolio while ignoring the possibility of doubling their income over time. That is backward. A better career can create more investment capital than a small investment improvement. If you raise your income from $60,000 to $120,000 and you do not spend the entire raise, your ability to invest increases dramatically. The portfolio then compounds faster. This is why you should invest in yourself. Learn skills, build experience, strengthen your network, increase your market value, move toward higher value work. Your investment portfolio is one engine. Your human capital is another. The more your income grows, the more fuel you can put into the portfolio. The source gives an example of someone who started with $10,000 but also worked hard to increase professional skills. Over several years, income rose from $60,000 to $120,000. Because income rose, the annual investment amount increased, and the portfolio reached more than $100,000 by age 38. That is the combined effect. Invest money, invest in yourself. Let both compound. This is a much stronger system than obsessing only over market returns. Now, let us connect the pieces. The $10,000 system is not meant to make you rich overnight. It is designed to give you a real possibility of financial freedom over 10, 20, or 30 years. It works because it combines several principles: diversify risk, hold long-term, use automation, maintain liquidity, capture market growth, use bonds to reduce volatility, keep opportunity cash. For major dips, rebalance periodically. Avoid emotional trading, invest in your own earning power. These principles are simple, but when combined, they create a strong structure. The safety net prevents forced selling. The growth engine compounds. The opportunity bullets allow buying during fear. Automation prevents procrastination. Rebalancing enforces discipline. Learning keeps you informed. Human capital increases fuel. That is the machine. Now, I want to discuss why $10,000 is the right psychological milestone in the source. When a portfolio first reaches 5 figures, the investor begins to feel the difference between cash and capital. A 6% return on $1,000 is $60 per year. That is small. A 6% return on $10,000 is $600 per year. That is still not huge, but it is visible. $50 per month appears, a dividend appears, interest appears, a gain appears. You begin to see that the money is doing something, that visibility matters. Behavior changes when the reward becomes visible, the portfolio becomes real, the investor becomes more motivated. They begin to see the relationship between capital and income. This is why the first $10,000 matters. It is not the finish line. It is the point where the machine becomes emotionally believable. Now, many people will say they do not have $10,000. That is fine. Start with less. The system can scale down. If you have $1,000, the same principles apply. 20% safety net, 60% growth engine, 20% opportunity bullets. If that is too much, start with building the safety net first, then invest monthly. The allocation is a framework. It is not a commandment. The important thing is to begin moving from idle cash and reactive decisions to a structured system. If you only have $100 or $200 per month, that is enough to build the habit. The habit matters first. Then the amount can grow. Do not wait until you feel ready. You will never feel perfectly ready. The market always has risk. The economy always has uncertainty. Inflation will not wait for your confidence to improve. Every year spent doing nothing is a year of lost learning and lost compounding. Start small if you must, but start. Now we need to talk about fear. Taking $10,000 of hard-earned money and investing it can feel scary. That is normal. Fear is not a sign that you should do nothing. It is a sign that you should build a good system. Fear becomes destructive when it prevents action completely. Fear becomes useful when it makes you manage risk properly. That is why the system includes a safety net. That is why it includes bonds. That is why it uses dollar cost averaging. That is why it keeps opportunity cash. That is why it rebalances. The system does not pretend risk does not exist. It respects risk and builds around it. That is what rational investing means. Not blind optimism, not total fear, balanced action. Now, what happens if you leave $10,000 in the bank for 10 years? Maybe the number stays near 10,000. Maybe it earns some interest, but inflation keeps moving. Purchasing power declines. Opportunities pass. You gain no experience with markets. You build no investment habit. You learn nothing about volatility. You do not build a compounding base. That is the true cost of inaction. It is not only the return you miss, it is the skill you fail to develop. A person who invests for 10 years learns how they behave in markets. A person who waits for 10 years remains a beginner. That learning gap matters. The best time to start was years ago. The second best time is now. That saying is popular because it is true, not because today is guaranteed to be the perfect market entry. It is not. But because starting begins the process, and process beats timing for most people. Now, let us discuss the lazy part more deeply. Lazy investing does not mean careless investing. It means removing unnecessary activity. Most people think effort equals results. In some areas, that is true. In investing, unnecessary effort can hurt. Checking the portfolio every day can increase anxiety. Trading frequently can increase mistakes. Trying to time every dip can create paralysis. Following every guru can create confusion. Changing strategies constantly prevents compounding. A good passive allocation looks lazy because it does not move often, but underneath it is disciplined. The laziness is only on the surface. The system is doing the work. This is one of the great advantages of asset allocation. You can focus your daily energy on areas where effort has higher return: career skills, health, family, business, relationships. Learning the portfolio grows in the background. That is how money becomes a partner instead of another job. Now let us be honest about the expected $300,000 outcome. If you invest $10,000 and add $200 per month for 30 years at 7%, the account can grow above $300,000. But the path will not be smooth. There will be years when the account falls. There will be years when the bond side disappoints. There will be years when stocks rise too fast, and you feel like you should be more aggressive. There will be years when stocks fall and you feel like you should be more conservative. This is why the allocation must be chosen before emotions appear. If you choose 70 divided by 30, understand why. If the market rises and you wish you had 100% stocks, remember that the bonds exist to help you survive the crash. If the market falls and you wish you had all cash, remember that the stocks exist to grow wealth over time. Every asset in the portfolio has a job. Do not fire an asset because it is not doing another asset's job. Bonds are not supposed to beat stocks in bull markets. Stocks are not supposed to be stable every month. Cash is not supposed to maximize return. Opportunity bullets are not supposed to be fully invested all the time. The system works because the parts play different roles. Now, the rebalancing schedule maintains those roles. If stocks rise too much, trim them back. If stocks fall and bonds hold up, rebalance into stocks. This feels emotionally difficult because it often means doing the uncomfortable thing, buying when markets are down, selling a little when markets are euphoric. But that is the point. Rebalancing is a rule that fights human emotion. It is a mechanical way to do what people say they want to do, but rarely do naturally. Buy low, sell high, not perfectly, not dramatically, but consistently. Now, there is a tax consideration if you rebalance inside tax-advantaged accounts. The tax effects may be minimal or deferred. If you rebalance in taxable accounts, selling can create capital gains taxes in taxable accounts. You may rebalance more through new contributions rather than selling. This is another reason to understand account structure. The source does not go deeply into tax mechanics, but the principle matters. Taxes are part of the system. Do not ignore them, but do not let tax complexity stop you from starting. Begin with simple, low-cost funds. Use appropriate accounts. Learn over time. Now, there is a risk of overconfidence after markets rebound. People often look back and say buying the dip was obvious. It was not obvious in the moment. In 2022, when markets fell, many people believed inflation would destroy everything. Rates would keep rising and stocks would stay weak for years. In 2020, during the pandemic crash, people feared the entire global economy was shutting down. In 2008, people questioned whether the financial system itself would survive. Buying during fear is hard. That is why you need opportunity bullets. The cash is not only financial, it is psychological. It says, I was expecting volatility, I planned for it, I know what to do. That is the difference between a prepared investor and a panicked investor. Now, opportunity bullets should be deployed in batches. Do not spend all of them at the first dip. If the market falls 15%, deploy some. If it falls further, deploy more. If it falls much further, deploy the rest according to a predetermined plan. This prevents emotional all-indecisions. It acknowledges uncertainty. Even when the market is down 15%, it can fall more. A batch system gives you discipline. Now, what if the market never falls 15% during your waiting period? Then the opportunity cash earned modest interest and gave you peace of mind. That is not failure. It is the cost of optionality. Every insurance-like tool has a cost. The safety net also has opportunity cost. Bonds have opportunity cost in bull markets. Cash has opportunity cost when stocks rise. But they all protect the system from becoming fragile. The goal is not maximum return in hindsight. The goal is a plan you can hold in real time. Now let us talk about the role of bonds more clearly. Bonds are loans to governments, corporations, or other borrowers. Bond funds can provide income and stability, but they can also fall, especially when interest rates rise. In 2022, many bond funds fell along with stocks because rates increased sharply. So bonds are not magic, but high-quality bonds still play a role. They can provide income. They can reduce volatility in many environments. They can act as a rebalancing source. They can create psychological stability. The right bond allocation depends on age, risk tolerance, rates, income needs, and the specific bond fund. A 30-year-old may choose less bond exposure. A 60-year-old may choose more. The 70 divided by 30 structure is a balanced example, not a universal law. The key is matching the allocation to the investor. Now, let us talk about global exposure. A fund like VT gives global stock exposure, while VTI and VOO focus on the United States. The United States has been one of the strongest markets in the world, but no country leads forever without periods of underperformance. Global diversification can reduce dependence on one country. On the other hand, U.S. companies are highly global already, and U.S. markets have strong structural advantages. There is no one perfect answer. A person who wants simplicity may choose VTI or VOO. A person who wants global exposure may use VT or combine US and international funds. The important part is to know what you own. If you choose VOO, you are largely owning the largest U.S. company. If you choose VTI, you include more of the U.S. market. If you choose VT, you include global markets. Each has a role. Do not buy symbols. Understand exposure. Now, the system's final lesson is freedom. Financial management is not only about becoming rich, it is about gaining choice. When your money works, your stress can decline. When your portfolio grows, your confidence can rise. When you have cash reserves, emergencies feel less destructive. When you have investments, the future feels less dependent on one paycheck. When you increase your income, your ability to invest accelerates. This creates freedom, not absolute freedom, but more choice, the choice to change jobs, the choice to handle emergencies, the choice to retire earlier or with less stress, the choice to help family, the choice to spend time on what matters. That is the real purpose. Money is a tool for choice. If you do nothing, inflation makes choices smaller. If you build a system, choices can expand. That is why $10,000 matters. It may not be life-changing by itself, but it can become the starting point of a system that changes your life over time. Now, let us summarize the structure in the clearest way. Your money should not sleep while you work all day. Saving feels safe, but if inflation is higher than your yield, purchasing power is shrinking. Investing does not require a fortune. $10,000 is enough to build a real system. Investing does not require daily chart watching. A passive allocation can work quietly in the background. The system has 3 layers: 20% safety net, 60% growth engine, 20% opportunity bullets. The safety net protects you from emergencies. The growth engine compounds through a 70 divided by 30 stock bond structure. The opportunity bullets allow you to buy during major market declines. Deploy the growth engine gradually if that helps you reduce timing anxiety. Set up automatic transfers. Choose broad, low-cost ETFs. Rebalance every 6 months. Keep learning without overreacting. Expect downturns. Do not panic. Invest in your own skills and income too. That is the system. It is not dramatic. It is not a get-rich-quick scheme. It is a get-rich-carefully system, and carefully matters because the goal is not to win one trade. The goal is to build wealth you can keep. Now, if you are sitting on $10,000 and doing nothing because you are afraid, ask yourself what inaction is costing you. Inflation is not waiting. Time is not waiting. The market will not become perfectly predictable. You will never feel completely ready. The first step will always feel uncomfortable. That is normal. Courage in finance is not the absence of fear. It is taking rational action while managing risk. You do not need to invest everything at once. You do not need to pick the perfect fund. You do not need to become a market genius. You need a system. Start with what you have. Build the safety net. Set up the growth engine. Keep opportunity cash. Automate the process. Rebalance. Increase contributions as your income grows. Then let the machine run. Years from now, the version of you who benefits from that system will be grateful to the version of you who started. That is how financial freedom begins. Not with a lottery moment, not with a perfect trade, not with endless research, with a system that turns idle money into working capital. Your money can keep sleeping, or it can start working. That is the choice. And the sooner you make that choice, the sooner the compounding machine begins.